Okay, while we're on the subject of taxes, I want to go through a little exercise that I go through in my classes because this is very near and dear to my heart. I want to talk to you in general about taxes, but income taxes in particular, and the marriage penalty. Because whenever I explain to people the marriage penalty, people's eyes glaze over and they say, "What? You mean that there's not a benefit? You don't pay less in taxes when you get married?" And very few people, yes, back in the 1950s when the tax code was originated, when people got married, if you had one person without an income and the man bringing home the bacon, as the stereotypical family might have been back then, and maybe wasn't, then yes, when two people got married, one of them had an income, the other one didn't. If after they got married, still one person worked and the other person did not work, then yes, their total tax bill went down. But in an era where most people, before they get married, they work, and after they get married, they still work, your taxes usually go up. And I wanted to show you how that works. So it all hinges on marginal tax rates and how our federal government changes the tax rate table in an unfavorable manner. Now, I'm going to go through a simple situation. We know that the real tax code is hundreds of thousands of pages. So basically, I'm just going to look at federal income tax, and we're going to ignore state taxes and all those. But basically, if you are single, we're going to start out assuming that I'm single, and my wife was single before we got married. But if you're single, you have no kids, and no one can claim you as a dependent. Back in 2005, 2006, I think is when these tables come from. You got a 5,350 standard deduction that you didn't have to pay taxes on, and a $3,300 exemption that you didn't have to pay taxes on either. Standard deduction, standard exemption. And what happens if you're single? Well, if you're single, you use this tax table. This is factoring in the standard deduction and exemption. On the first dollar you earn up to the 8,850th dollar, you pay no federal income tax. Your marginal tax rate, that word marginal just means additional. The additional tax you pay on those first dollars is nothing. So, but for the 8,850 first dollar, for that $1, the 8,850 first dollar, you pay 10 cents in tax. And also the 8,850 second dollar, 8,850 third dollar, you pay 10 cents on each of those dollars. So the marginal tax rate for dollars in that range, the additional tax is 10 cents per dollar. And that lasts up until the 16,000th, 675th dollar. And then on the 16,676th dollar, you have to pay 15 cents of each of those dollars in tax above 16,675 up to 39,675. So you have to calculate your tax in different brackets. So these brackets are unique percentages only for the dollars in those brackets, not for the earlier dollars. It doesn't change how much you pay on those first dollars. So how do you calculate your tax? Well, let's suppose that using nice general round numbers, that I earned $100,000 that in a certain year, and my girlfriend at the time was making about $50,000 a year. Nice round numbers. Then my wife, her name is Angie, when she was my girlfriend, she would pay no tax on those first $8,850. And then in the next bracket, that bracket is $7,825 wide times 10 cents per dollar. That's $782.50. And I paid the same tax for income in that bracket. In the next bracket, between 16,676 and 39,675, there are $23,000 that get taxed in that bracket at 15 cents each, and so we each paid $3,450 for the dollars in that bracket. Now here's where things get a little different. If my girlfriend at the time, now my wife, earned $50,000, then for each of those dollars, oops, I need to fix this number here. For each of those numbers, dollars above 39,676. That's going to be about $10,324 times 25 cents. Let's see. Oh, sorry, $325 in that range. Then, so in any case, 10,325 times 0.25. Hopefully that's 2581.25 that she owes in taxes for the dollars she earns in that bracket. Even though there's $45,250 in that bracket, she doesn't earn all those dollars up to $84,925 because she only earned about $50,000, round numbers here. So I'm not divulging secret information. So if you add up all the tax she owes in the different brackets, it would be about $68,1375. Now, if I earned about $100,000, then we keep adding up taxes as we earn them in the different brackets, multiplying those dollars times the appropriate percentage. And if you do that up to $100,000, you end up with $20,095. Sorry, $20,095 for somebody with a $100,000 income. So as single people, the total amount of tax would be, add the $20,095 plus the $68,13, and you get this $26,908.75 down here. Let me move that over so that you can see that better. Now, a couple of economics concepts. Since Angie's last dollar she earned is in the 25% tax bracket, we'd say her marginal tax rate is 25%. What that means is that if she got a raise, then 25% of the raise would get paid to federal tax. Or if there was an option to, say, start a home business, well then, if she was single, 25% of those dollars would go to tax that she earned. The income tax, now there are a lot of other taxes that she'd have to pay, but as a single person earning $100,000, your marginal tax rate is higher. 28% of my income would go to the federal tax. Now, not to mention the Social Security tax and the Medicare tax and state income tax and sales tax and property tax, but 28% is the federal marginal tax rate. So if I earned an extra $1,000 working overtime, then 280 of those dollars would go straight to the federal government because my marginal tax rate is 28%. But we also look at the average tax rate. Now, average is not useful for decision making because it doesn't tell you should you work overtime. That's the marginal tax rate. But the average just tells you, on average, for each dollar you earned, how much went to federal tax. And for somebody with a lower income, that's going to be lower. For Angie, 13.6% as a single person, and for me, about 20%, which seems fair because we call this income tax we have in the United States a progressive tax system. Progressive means that the marginal tax rates and the average tax rates are higher for people who earn more. Now, we got married on the next to the last day of 2006. True story. And because of that, we could not use the single tax table. We had to use the married tax table for the whole year. And so if you add our incomes up to $150,000 and you go through and pay the taxes in each of the tax brackets, I left the last bracket here empty just for fun. $150,000 on those dollars above 136,325, 150,000 minus 136,325, that leads $13,675 to be taxed at this 28% rate, times 0.28 is going to give us $3,829 that we had to pay in this simplistic situation for federal tax. Now let's add those up and see what we get. $27,320. Now this is an example of the marriage penalty. this 27,320, we're paying more in tax just because we got married. Now, actually, that's like the minimum. This is only $400. Now, in reality, it's going to be a lot more because one of the other things that's fun about the federal tax system is that all kinds of deductions and exemptions phase out for married people very quickly, but not for single people. For example, student loan deductions, home interest deductions, all phase out much more quickly for married people than single people. And so another thing that affects a lot of people is you can't deduct all that interest that you're paying on the student loan anymore after you get married, but as two single people, you could have deducted it very easily. So that's an example of the marriage penalty.